Welcome to the Business Trendsetter podcast, where we talk about trends and how to grow your business. My name is Manny Turan.
And I'm Adam Hartung.
We are Spark Partners. Welcome to 2023. We've got lots of exciting things to share with you this year. Certainly a lot of things in process, a lot of trends that are unfolding. Obviously, the big five trends are still in motion. And we, of course, want to bring you lots of value by helping you to rethink the way you think about business growth, give you some really good tools you can use. And I thought today, Adam, as we discussed a minute ago, the conversation about really what it takes to raise money and why it's so important for entrepreneurs and established companies alike to have a bit of a war chest at their disposal. So give us your thoughts on why it's important for companies to raise money.
Well, as you know, the number one thing we preach to people all the time is the most important thing in your business is sell more stuff. That sales are the best predictor of future success. When you're selling and selling more stuff, then that means customers are coming to you and you're on trend. So you can never underestimate the power and importance of having sales. But at the same time, you can sell stuff so fast that you can have a cash flow problem. Or sometimes, if you want to keep growing your sales, you might not have the resources handy to launch a new product line or to expand into a new market. So you say, well, I'm limited in terms of how I can grow because I don't have enough cash. So the second most important thing I think you need in terms of being able to run a long-term successful business is the ability to generate cash. Now, there's a lot of myths around this, and then there's a lot of facts. And maybe we could try to go after both of those today.
Sure.
One of the myths in business is that the best money or the good money is the money that you raise yourself and don't go out and use other people's money. And then that's because it's using other people's money is associated with risk. In other words, it's their money. They now have a voice in your business, and that voice can impact your decision making and impact the things like new products you want to launch, et cetera. And so it's like keep people's voice out of your business to let you be the sole voice, and don't use other people's money. And that's just a ridiculous way to think about it. I want to start right there. You should be listening to a lot of voices as you go forward in business, and having somebody put money in your business who has a stake in where it's headed and therefore has a voice in it is not a bad thing. It's much better than your Uncle Fred or your retired Aunt Zelda or whoever else it is that you're talking to that really doesn't know much about your business and isn't in there every day and doesn't have a vested stake in its future. If you've got an investor with a vested stake in your future, you're going to have more productive conversations that are going to be really focused on how you sell more stuff. So having somebody else close to you, vested with you in the future of your business is not a bad thing. And the second thing is just having enough money. I've seen people who say, I've got this great small business, or I've got a great medium-sized business. I grew from small to medium-sized, and I did really well. But now I'm getting a lot more competition, and especially if I try to expand outside my core market, whether it's core product market, core geographic market. I'm needing to expand if I want to keep growing my sales. But when I do that, I run into other competitors who have good funding. And the point there that I always try to point out is that, that could be a competitive weapon used against you. When somebody else has cash, then they can use that cash to lower the price. They can take a lower margin in the business, and they can use that to undercut you and hurt your business. They also can use that cash to launch new products quicker and get to your customer quicker and try to steal your customer away with the new products. Mm-hmm. So people that have cash can use it as a competitive weapon. I knew a young man, I didn't really know him well, but he approached me to raise money, and his whole objective was to raise a few $1 million. And when he was going to go around in Northern California, around big cities, and he was going to buy up independent car washes. And his idea was he thought he could buy up about a third of these car washes, and then what he would do is he would just drop the price to the really, really low price for a car wash. Like instead of 20, it goes to 5. But the whole objective of saying, I got a war chest, I could go out and do car washes at $5 car wash, I'll lose money, but most of my competitors, most of the remaining independents, they can't survive that. They'll shut down, and I'll buy up those assets for pennies on the dollar. Because who's going to want to buy car wash assets when car washes are $5? Then once he got enough of the car washes, he was going to raise the price back up to 20 again, and he would have control of the market. That's using a financial tool as part of your strategy for long-term success.
Right.
And what I see all too often is most of the people that we work with in the small and mid-sized companies don't think of financing as a competitive tool. They don't even think of it as a tool. but it's part of your strategy, how you're going to raise money and how you're going to use money. So just starting there, I mean, there's just so many myths about raising money and people who don't go out and do it. And what I'm trying to tell people all the time is, just like you would focus on being good at knowing your customers and you value good salespeople, knowing that your market, and therefore you value good marketing people, and known channels, marketing people can go through Facebook and online media and other channels to reach customers. Just like you would say, I've got great people in my operations that know how to work with my suppliers to get leading edge products, to get treated well, to get better terms. And you think, you don't think twice. It's a great idea to invest in salespeople, to invest in having good supply chain people working for you. But then it's going to say, well, do you have somebody that's vested in reaching out and putting together a story about your business to raise money, that is out there communicating with private money, the family offices, the private equity firms, venture capitalists, banks, small investment banks? Do you have somebody that's out there building your story, talking to the world, and saying, hey, you know what? Whenever we want to, we could, pull the hammer on this opportunity and raise $500,000 or $2 million or $7 million. I've never met a small company where the guy says, yep, I got people working on that. We're always evaluating the opportunity to raise money. I've never had someone say they do, but it makes so much sense that you should.
And I've got a great story actually to share with you. So there's a person I know that has an interesting technology, or it's actually a service that is delivered via a nurse. So I won't go into too many details. They're kind of in hyper growth mode, but they're starting to hit some brick walls. And one of those has to do with exactly this. So about a year ago, I met them for the first time, and they were growing hand over fist. They couldn't find enough nurses, but they were finding them because they added some value to the nurse that was almost too difficult to walk away from. So they were growing and growing and growing. And I asked them, hey, are you guys raising any money? And the answer was no, we don't need to. We're really, we're doing just fine. And we're going to grow organically, which, there's value to that. But one thing that happened is they were playing in a non-competitive space. In other words, they didn't have any competitors, quote unquote. They did, they just didn't know it.
Yeah.
Fast forward a year later, I talked to them about a month ago, and they were up against a bowling ball, because now they're the sleeping giant, which were these giant organizations that have thousands of nurses, were starting to recognize what they're doing. And by that time, it was too late. They're going to be squashed because they don't have a war chest. They don't have any money to go out and actually execute on their plans. And they're going to be dwarfed by these other companies, where once they had that opportunity, now they're in the process of losing it.
Yeah. One of the things I find is that people don't treat cash the way they treat inventory. If you were selling mobile phones and you had 100,000 mobile phones, you would be saying, I need to get those mobile phones sold. I don't want any aging inventory here. I want to sell those phones, and then maybe I'll get some more. But people have cash, thinking, well, let's put cash in the bank. Let's hoard cash. Let's save cash. There's all these, keep your powder dry type comments that go around. And I think that's why it's an especially important conversation we're having now in this recessionary times. But cash is just like any other item, and it does become aging inventory. If you've got cash sitting back there and you're not using it as a competitive tool, then it doesn't do you any good, right? It's not helping you sell more stuff. It's not helping you launch new products. It's not helping you be a better competitor. So when you have cash, you should be saying, how can I use this cash to offer discounts to my customers, to launch new products, to do product bundles, to do things that would help me to grow the business? But people say, why do they hoard cash? Because they're afraid they can't raise more. And I'm like, okay, now you're living in fear. Your fear of this skill set is causing you to make bad business decisions. So you need to build that skill set. If you have the skill set for raising money, then you're not going to be afraid to spend money, because you say, I'll go raise more money.
Right.
And so you should have somebody out there working at it. Why? Well, because when you need money isn't when you raise money. Right? If you walk in and say, hey, I've had a business, but I'm in trouble now because I don't have enough cash, then people are going to really extort.
They're going to walk away. They're going to run away.
Yeah. So you have to be in the market saying, here's my story. This is the business I'm in. This is the trend I'm building on. This is why my revenues are growing. I want you to be part of this. No, I don't actually need your money, but I could put it to use very effectively. And I'd like to get you in on my business so that we can continue to grow. And that way you're constantly raising money. You know what's going on in the fundraising side of things. If we take a look at people like Steve Jobs or Jeff Bezos or Elon Musk, one of the things that we see across those great entrepreneurs, Richard Branson, another one, is the ability to raise money. They started early in their career saying, I'm not going to be in this alone. I'm going to raise money. I'm going to make partnerships with corporations. I'm going to take grant money. I'm going to use private equity, venture capital. And they were reaching out, raising money all the time. And they were able to build these giant businesses because they could raise money. Just this last week, SpaceX announced that it's going to raise another $750 million from Andreessen Horowitz. So that means that what's happening is that they've gone out there, they've built this rocket ship company, they're sending satellites into space, they've got plans to do more, placing things in space, recovery from space, as well as they're now looking at transportation or human transportation into space, selling tickets like Virgin Galactic is doing. And so they've gone and said, look, this is our business model, this is our cash flow plans, we'd like to raise some more money so we can grow the business. So even though they're not sitting on the edge of death or the edge of bankruptcy, SpaceX is raising another $750 million to look at the next thing it can go do. If we look, those are our role models, and our small to mid-sized companies need to be sitting there saying, hey, am I putting my story together? Am I running my story behind people with money to see if it's a sellable story, to see if we fill somebody's needs in their portfolios? If you're not working at it, then what makes you think you're going to be good at it when you need it? And if you don't have that skill, what makes you think you can survive without it?
Yeah, I talk to lots of people, and one of the sentiments of why they don't raise money is because they don't want to dilute themselves. And the whole adage of 100% of zero is zero, it really rings true. The best kind of money out there, beyond even quote unquote free money or grant money, is of course customer money. Because if you've got customer money and you've got these revenues, it means you've got a healthy company, a healthy value proposition. You've got your value delivery on point. Everything's aligned. It means you're actually making money. So I would argue any day at any level that customer money is more valuable than grant money or quote unquote free money. And so, how do you think that that makes SpaceX makes them more viable and more competitive to their counterparts by now having raised $750 million? All
right, so we can look, and we've got Virgin Galactic, like I said, you've got Blue Origin. Bezos, Blue Origin, and then you've got SpaceX, and they're sitting there saying, how do we take things into space with a revenue stream and become profitable? And at this time, they're not making enough money that it would be great. So they've all got to try to get to the next level of volume. They've got to grow their revenues in order to try to become more successful. By raising more money, now that puts SpaceX in a position to buy more rockets, to do more research, and to also go convince more markets of the opportunities that they offer them, whether it's for transportation services or if it's for placement into space or recovery from space or whatever segment of the market they want to reach out to. They've now got this $750 million pocket that they can reach into. And if Branson doesn't come up with a way to raise money to meet that, then what happens is he'll start to fall further away. And Blue Origin will start to fall further away and let Tesla keep growing its market share out ahead of everybody else. So that's how they can use that $750 million as a competitive tool. Now, that's a lot of money. And I know that most of the people listening to our business aren't out there looking to raise $750 million. But, I can wind back the clock 40 years and I can say if it was 1982 and you had a great business idea and you wanted to raise $5 million, that was hard. It was very, very hard. There were, a handful of venture capital companies. Banks did not offer risk money. It was only loans. You had to have assets and revenues backing any loan that you got, so you couldn't borrow money to start a business. You can go to a bank for it. Investment banks only work with giant corporations raising, millions and millions of dollars. It was hard to do. Today's such a different world. There are so many venture capital companies that are looking at all different sorts of industries. And they look at it. Some do, angel investing, seed investing, all the way up to
crowdfunding. I mean, there's a whole host of different funding opportunities for sure.
Well, crowdfunding is a great example. That didn't exist, right? Crowdfunding's been around about 10, 15 years. Today, anybody can put a product up on crowdfunding and try to raise $100,000. And you might say, well, I don't need $100,000, and I don't really understand crowdfunding. And I'd say, well, you know what? Maybe you should go raise $100,000 on maybe a preferred equity product, which gives your investors no voting interest in the company, and you guarantee them some sort of a long-term rate of return through a preferred dividend at some point into the future. But what's happened is you're getting experience at raising money. So you're out there raising a little bit of money, saying, oh, I've done some crowdsourcing. I now know what works. I know how people react to it. I know how they like my story or what they didn't like about my story. You're getting feedback on that. Same thing if you're running it by venture capitalists saying, hey, I'm out there, I'm trying to raise like $1 million. Venture capitalists, if you get them to listen to your story, they will give you an answer. They may say, you know what, I listened to this at first and I thought you're in a good market, but I don't believe your business plan. Or, you know what, you're not selling me that you're on the trend. Or, you know what, it looks to me like your costs long-term are going to be too high. I don't see a way that you can recover it. Until somebody who's got an interest in investing tells you that that's the problem, you're not going to rewrite your business plan. You're going to sit there with it on the shelf thinking you're ready to go when, in fact, it's not ready to go. It needs to get market tested, just like a product does. Raising money, you're selling your company to people. You've got to have the right story that makes sense to everyone. And sometimes the things they'll point out to you are true. They're like, oh, you know what? It is a problem that my back end is getting more expensive as I grow. My back end's growing faster than my revenues are. And wow, I do have a profit problem here that unless I reconfigure my business somehow, I'm not going to be able to survive long term. So I always like to tell people that 90% of businesses don't make it 3 generations. There's the founding generation, and I'm not saying in terms of family. I'm saying there's an initial founder, then somebody comes along and they're running the business second. Could be appointed by the founder. It could be the first level of private equity. Some outside money comes in and replaces the initial founder. Then you get the third level, which is we could think of often happens around a larger funding piece. But anyway, we're now down the road 30, 35, 40 years. 95% of companies never make it to that third step. Why is it they don't make it to that third step? Because they don't plan for the funding to grow. They don't plan for long-term funding. And by not planning for long-term funding, they simultaneously don't think about the exit plan. So they're going along running the business, doing their thing. They have some business success. It goes great. 25, 30 years have gone by well. Then what happens is they get into some situations. They need to make more investments. They don't have the money. They never learned how to raise the money. The competitors come at them. They do know how to raise money. The competitors come at them hard. They don't know how to raise the money to fight back, and boom, they get trashed. They just here they've made the gun, but they ran out of ammunition, and they didn't think ahead to say, I got to have a good supply of ammunition, meaning cash to keep myself in the game, keep myself in the battle, and therefore they missed out on that third one. So all of this just points to that it's never too soon to start getting out there and testing the waters to raise some money, to raise some cash.
The idea of having an investor as a partner, as you mentioned, not only does it give you a good sense of what is good and what's bad in your business, you can address it usually from a professional investor side, but also it gives you a level of accountability that's going to keep you moving, and it's going to give you also a bit of the band of brothers kind of mentality. When you're going after a new market, you can reach out to your investors and say, hey, listen, this is the new market we're thinking about. Can you use your vast resources to see if that's a good place to go towards? I mean, especially if they're sophisticated, they're going to have some business analysts at their disposal. They're going to help you to navigate those waters because they want to protect their investment. And obviously, if you're going to be in the mix with them, you're going to both have that extra edge to succeed.
Now, let's say that you don't. So most people, when you say raise money, they think of common shares. Oh, I'm going to go sell stock in the company. I'm going to sell 5, 10, 15%. The world's not that simple anymore. We're much more sophisticated. You've got private equity shares that you can sell when they're non-voting. You can also sell general
convertible
shares.
Notes. There's safes. There's lots of things out there.
There's a lot of products, and some of them have voting rights and some of them don't have voting rights, right? And so we'll need to know what those products are so that we can get out there and understand what people buy. But most importantly, it helps you set a value. Once you start raising some money, you've got some outside third-party influence that's helping you say, well, I think my company's worth, and you've got a value on it. And then you could keep looking over time as you raise more money. Is the value going up or is the value going down? Now, here's the second place where this gets really important. Everybody's having trouble hiring. The demographic issue that you and I have talked about for 3 years here, the big trend around demographics, aging population, not enough workers. We're seeing that today. We still, despite the fact that the Federal Reserve has jacked up interest rates in 2022 so much, we still see the economy getting squeezed, yet unemployment remains at these really low levels, down in the 3.7, 4% range for unemployment. To keep employees, you can give them a stake in your company, but not if you don't have these opportunities out there to value the company. So if you're sitting there saying, I would like to keep employees in my company, I'd like to get the really highly talented people, one of the best ways is to offer this form of compensation where you say, here's your cash, here's your bonus, but here's something that's tied to the value of the company. It could be phantom stock, it could be real stock, it could be preferred stock, it could be convertible stock, all these different kinds of things. But you could say, you now have a vested interest in this. And by the way, I'm not saying the company's worth $100 million. I have gone out in the marketplace, and the marketplace has said the company's worth $100 million. And by the way, you're not just dependent on me buying your stock back at some future value. I'm now demonstrating that I have third-party investors, which means there could be other people that you could sell your ownership to besides me. And all of this also points towards a future point at which we either go public or we have a private equity buyout or we have an acquisition where somebody takes over the company. And then whatever these employees have as ownership, it comes good and they now have big checks coming their way. So if you're out, you can't give people equity in your company in a way that's really going to feel tangible to them, make them think that they can build value unless you've got a third-party connection because you're out in the marketplace raising money. So raising money becomes a way to really help hire and help retain your best people.
Yeah, I couldn't agree more. And, I kind of fell victim to that with my previous business. I kind of mentioned to you last time in the mid 2015 timeframe, 16 timeframe, where if we would have had cash, if we would have raised money and we would have pivoted to where the customers were screaming for us, it would have been a different story. But the fact that we didn't have any money, our war chest was depleted, and we didn't have the ability to compete with these giant companies like Raytheon that were giving my engineers 15, 20% higher salaries and a $15,000 to $20,000 signing bonus. If we had cash, we could have had more of a ability to withstand the storm. But long story short is it didn't survive, and that's part of my success is my failures, of course. But how do you expect these companies these entrepreneurs to really go after money if they have no idea of where they're going to spend it? So, how would you say that obviously salespeople is important, marketing people are important, but how should an entrepreneur or an executive, once they raise the money, what's the best use of the money?
Well, again, I always believe in growing your business. So can you look to new markets? If you're in one geography, like, for example, the guest we had who had a wine business in Tucson, great business, doing well. If he had a little more money, I'd say, well, what's another market that's kind of like Tucson, one that's overlooked, one where you could have a local identity, a local brand, and do well? Could you find another market? Because I've heard of people doing something similar to him in places like Austin, Texas. So are there other places you could expand geographically? Could you offer beyond? A lot of people that sell wine find that they can sell their luxury food goods like very high-end olive oils, and that's a non-perishable or perishables like cheeses, or something else. There's another opportunity. So when people buy wine from you, they can buy these other products from you. So market expansion, product line expansion, expansion into new technologies. If you've got a product that has a technology element to it, could you, expand that? Could you, see what customers' needs are that are unmet? You're selling them a product that solves a problem. What other problems do they have where if you had a product, it would meet their needs? So you could bundle products together and get a bigger sale by solving two problems for the customer at the same time. So your customer's needs, wants, and desires that you could attack them. That's where you would go with the money. Because again, back to what I said earlier, think of money as aging inventory, just like you would if you had a warehouse full of cell phones. You don't want money just sitting around. You want to put it to work. And so make sure that you should be thinking about this. Now, what's our ultimate answer for that? I tell people all the time, do you have a white space project? Now, I don't want to go nuts here in this, but a white space project is where you have a small team dedicated on doing something new. And I always say all companies should have a white space team out there that's looking at new opportunities, figuring out how to do something new. So I often, when I'm dealing with groups, I'll say at the end of it, I've told you now about a white space. What if I came to you and I said, hey, I just won the lottery. I won $1 billion in the lottery. And I've decided I want to come into your company. And I'm going to give you $1 million, but here's the rules. I give you $1 million. You can only put it in a white space team, and you have to start the team within 5 working days or 1 week. Can you stand up a white space team in 1 week to take the $1 million and go roll? And people always look at me like, well, I don't have that. Because what they think is they want to get the money first and then go out and maybe come up with an idea. But the amazing thing is if you start thinking, what would I do if I had an extra 100,000, 200,000, 500,000, million, 2 million, 5 million? If I had that money, what would I do? Not just more of the same, but where would I go? What geographic expansion? So when an entrepreneur says, well, what would I do with the money? I'm like, if you don't know, you've got a problem. You and your team should be sitting there saying, wow, if we had that money, if it fell in our laps for whatever reason, then where would I go with it, right?
Right.
And then you should be, because then once you get motivated, like, oh God, I really wish I had 200,000 to do this. Then you've got the motivation to go off and again, help you raise money so you can grow your old business and grow your new business.
Exactly. Hey, let's downshift slightly, Adam, and talk about, you mentioned customers and the importance of customers in a business, right? I mean, they're central. Let's talk about a recent snafu that happened with an airline that once was, charting new territory and is now kind of on the ropes a bit. So let's talk about Southwest Airlines here and what happened, 2 weeks ago?
Yeah. Well, everybody knows that Jim Collins is a fraud, right? And if they don't know it, they know it when I meet with them because I tell them that Jim Collins is a fraud. Jim Collins wrote Built to Last and he wrote Good to Great. And it's a bunch of crap. It's a bunch of focus on your core. Don't ever go do anything new. It's just, it's the roadway to hell if you're in business. You don't want to follow Jim Collins. Jim Collins, one of his most admired companies in these books is Southwest Airlines. And Southwest Airlines is now suffering from exactly the problems that you get if you try to follow the Jim Collins approach, which is to just constantly try to do more of what you've done, better, faster, cheaper, better, faster, cheaper. And what we see in the case of Southwest is they have this point-to-point network. They've never become a major airline, considered a low-cost provider, although every time I do ticket pricing and I try to compare them with United or American, I don't save any money, so I never fly them. Anyway, here you got this airline, and it doesn't update its technology. It doesn't update its business model. It doesn't update with trends, and so it starts getting further and further behind. Boom, we hit a bad weather Christmas. So now we've got some problems related to the pandemic where you laid a lot of people off. Do you get them back to work, get the planes back flying? You're constantly running at nearly 100% of capacity. That is, of course, a challenge for the operations people. But because they didn't invest in the market, in their technology, they didn't invest in getting to the next level. They didn't invest in innovation. They just kept being Southwest, Southwest, the carrier it was, with the story of Love Field and, keep constantly talking about the past. Whenever you have a capacity operation and all of a sudden you get some bad weather, their whole technology just blew up on them.
Yeah.
Just blew up on them, and they weren't able to service their customers over the Christmas holidays. And, I don't know, like I said, I haven't flown Southwest for many years and I won't fly Southwest. I don't know why anybody would going forward. I heard one guy on television say that Southwest is the safest operator of 737 aircraft. And I was kind of like, oh, wow, that's like saying nothing, It's kind of like saying Dairy Queen's one of the best manufacturers of soft serve ice cream. Wow, whoop-de-doo. The reality is that all airlines are safe. You rarely see one of these planes fall out of the sky. I want to get to my location on time, and I want to get there comfortably without feeling harassed, abused, and having problems getting there. And so what Southwest keeps failing to do is get people from A to B on time without a lot of harassment. It wasn't just Christmas. You might remember last summer. They fell apart in the middle of summer whenever their systems went down. They were leaving people stranded. They couldn't get anywhere. So what we're seeing here again is that focus on your core, keep trying to do more, better, faster, cheaper, rein in your costs, manage your costs, try to manage for long-term profitability rather than thinking about customers, thinking about the future, thinking about innovation, thinking about where you're going to grow, thinking about how to expand your business. That has now killed Southwest.
Yeah.
They got operations that aren't working. They're charging as much as United and American do for coach fare tickets. And the only people that are flying them are people in third-tier markets who feel like they don't have another option. But even those people are now starting to say, like at Christmas time, I met some people that were in a Southwest market. They drove for 2.5 hours to get to Atlanta so that they could take a major airline to get to the West Coast. So they didn't get stung like the people who had Southwest tickets.
Yeah, and I think what's happening to Southwest is what happened to a lot of these other companies in the Jim Collins books, like Circuit City, like Sears.
Yep.
Right? They all fall under the weight of their own success, but it doesn't last. I think I used to love Southwest Airlines. They were my chosen airline 20 years ago, 15 years ago. I loved it. It was point to point. It was inexpensive. There was no bag fees. Now I just don't fly them as much anymore. I just go to the common market. And matter of fact, I'm going to Las Vegas this weekend, flying Frontier. And I just went out to the open marketplace and I compared their rates were about double what Frontier was. Matter of fact, I'm going from Tucson to Las Vegas for $100 round trip. I just can't. Southwest.
I mean, when you're trying to say I'm going to win in a price war, and then you're going to get the Frontier, you're going to get your Spirit Airlines, you're going to get your people who, if it's what we're about is cost, we're going to show you what low cost means. I don't know if you've heard the stories, but like Spirit Airlines doesn't have any light bulbs installed in their entryway. They don't have a receptionist for the company. They take cost cutting way beyond what Southwest has. So when you say, we're one of the low-cost carriers with Spirit and Frontier, what you saw immediately was, no, you're not low-cost. You can't compete with those other models that a Frontier has.
Yeah, you can.
So, I think what we want to say here is we're starting 2023 is that people need to realize they got to sell more stuff. Selling more stuff means getting into new markets. It means growing your product line, growing your geography, and when you do that, you can't rely on having it all done with your own money. And you certainly can't get there if all you're thinking about is how to cut costs. So you have to say, I'm going to think about growing, and that means I'm going to start thinking about how I raise money. And raising money becomes the second most important thing after selling more stuff. And if you don't have that skill set, you need to build it. And if 2023, if you think it's a tough year that you're getting into, then get out there now with building that fundraising skill. Start today. Don't wait. Commit to yourself. You're going to go out in the marketplace and try to raise some money. Maybe you put together an offering and you go to your customers. Maybe you put together an offering and you go to your suppliers. Say, hey, would you like to share in our expansion? Just go to a crowdsourcing platform. Think of the different ways you can go. And if you don't get the money, take it as a learning experience. Don't just say, it's bad. Say, what did I learn? And then build on that. Because when you get to the point people want to throw money at you, you're probably going to win.
Yeah, and that's a huge humility exercise. Taking that feedback, going back to your team and telling them, hey, listen, this is what we've heard from investors. Let's take a hard line look at what they're saying because they're out there in the marketplace. They do this for a living. They know better than we do. Let's listen to them and let's retool. And if you have any questions for Adam and I, we're always available for discussion. Manny at sparkpartners.com and Adam at sparkpartners.com. This new year, 2023, is going to be a banner year, irrespective of what's happening and all the calamity. People on these pulpits saying that the sky is falling. Adam and I believe that this is a great time to be in business. And the moves you make right now, these advanced moves of leaning into your sales opportunities, leaning into using the cash that you raise or you have in hand to grow the business, the time is right now to make that decision and put this thing into action.
Hey, people want to get high rates of return. And right now you've got Netflix off 67%. You've got Meta off like 55, 60%. You've got Amazon down something like 50%. You've got Microsoft went nowhere last year. You've got Apple down about 40 to 35%. People are not putting their money in those stocks, but they've got money. And so they're looking for places and they're looking at a wider spectrum of opportunities. That's why 2023 is the year to get after it.
Very well said. With that, we'll talk to you next week. And for everybody, tune into our podcast here. We help you to understand how to grow your business by looking at trends, understanding your customers, and of course, learning how to spend the money that you raise. Take care, Adam.
Thank you.
Cheers.